Hello, everyone. Welcome to the market opening bell on Monday, September 1st, your 10-minute guide to the stock market. Let's first review the performance of US stocks last Friday. The core PCE data, closely watched by the Federal Reserve, met expectations, but investors took profits ahead of the US Labor Day long weekend, leading to a decline in US stocks. The S&P 500 fell 41 points or 0.6%, closing at 6,460 points. The Nasdaq dropped 249 points or 1.2%, closing at 21,455 points. The Dow Jones Industrial Average dipped 92 points or 0.2%, closing at 45,544 points. The Nasdaq Golden Dragon China Index, reflecting Chinese concept stocks, rose 120 points or 1.6%, closing at 7,912 points. For the week, the Dow and Nasdaq both fell about 0.2%, while the S&P 500 dropped 0.1%. For the entire month of August, the S&P 500 rose 1.9%, marking its fourth consecutive monthly gain. The Dow gained 3.2% and the Nasdaq rose 1.6%. Nvidia continued its decline, dropping 3.4%. Reports indicate that DeepSeek has decided to use Huawei's AI chips to train some of its smaller AI models to reduce reliance on NVIDIA chips. However, DeepSeek will continue using NVIDIA semiconductors for its largest AI models. Additionally, reports suggest Alibaba has developed more advanced chips to counter US export restrictions. Other chip stocks such as AMD and Broadcom fell over 3% to nearly 4%. Alibaba also announced its earnings, and with AI driving accelerated growth in its cloud computing business, its US ADR surged 13%. Separately, the Trump administration announced on Friday the revocation of technology use exemptions for Samsung Electronics, SK Hynix, and Intel subsidiaries in China, further tightening Beijing's access to advanced chip manufacturing technology. These exemptions, initially granted by the Biden administration in 2023, allowed Korean chip giants to continue expanding production in China to avoid market disruptions. Samsung and SK Hynix heavily rely on China for memory chip production, widely used in smartphones and consumer electronics in China. Revoking these exemptions will significantly weaken their manufacturing capabilities in China and may disrupt global supply chains. Tesla fell 3.5% as the company officially appealed the ruling related to a fatal autopilot crash. Supermicro Computer dropped over 5% after the company reiterated weaknesses in its internal controls over financial reporting. Caterpillar warned that tariffs would result in a 1.5 billion to 1.8 billion US dollar impact, with its stock closing down 3.7%. Dell saw a weak profit outlook for the third quarter, with its stock falling 9%. On the economic data front, the August University of Michigan Consumer Confidence Index fell to 58.2, down from a 5-month high of 61.7 the previous month, revised lower from a preliminary estimate of 58.6 and well below the market's initial expectation of 62. This marked the first decline in consumer confidence in 4 months, primarily due to heightened inflation concerns and a sharp deterioration in conditions for purchasing durable goods. Turning to Hong Kong stocks, the Hang Seng Index opened 96 points higher last Friday, surpassing 25,000 points and reached a high of 25,278 points in the morning, up as much as 279 points. The gains narrowed in the afternoon, closing at 25,078 points, up 79 points or 0.3%. The Hang Seng China Enterprises Index rose 30 points or 0.35%, closing at 8,947 points, while the Hang Seng Tech Index gained 30 points or 0.5%, closing at 5,674 points. Total market turnover was 335.6 billion Hong Kong dollars. For the week, the Hang Seng Index fell 1%, and the China Enterprises Index dropped 1.5%, ending 3 weeks of gains, while the tech index rose 0.5%, marking 4 consecutive weeks of gains. For August, the Hang Seng Index rose 1.2%, the China Enterprises Index gained 0.7%, and the tech index surged 4.1%, all achieving 4 consecutive months of gains. Southbound fund flows into Hong Kong stocks recorded a net inflow of 12.046 billion Hong Kong dollars last Friday, including net purchases Tencent 1.584 billion, Alibaba 1.149 billion, Innovent Biologic 718 million, Huatai Junan International 261 million, XtelPi Holdings 231 million. Net sales include Xiaomi 861 million, New China Life Insurance 334 million. Statistics show southbound funds have net purchased Alibaba for 6 consecutive days, totaling $5.975 billion, while net selling Xiaomi for 6 consecutive days, totaling $3.96 billion. Technically, Hong Kong stock ADR suggests the Hang Seng Index will open 387 points higher today at 25,466 points, likely surpassing the 10-day and 20-day moving averages. Recently, the Hang Seng has fluctuated around these two averages, with breakouts or breakdowns having little significance. The 50-day moving average at 24,781 points is the key level to watch. A break below could see a test of 24,350 points. In mainland China, the three major A-share indexes rose, with the Chinex index surging over 2%. The Shanghai Composite Index closed at 3,857 points, up 14 points or 0.4%. The Shenzhen Component Index closed at 12,696 points, up 124 points or 1%. Total turnover in Shanghai and Shenzhen was 2.7982 trillion yuan. For the week, the Shanghai Composite rose 0.8%, the Shenzhen Component surged 4.4%, and the Chinex soared 7.8%. For August, the Shanghai Composite gained nearly 8%, marking 4 consecutive months of gains, while the Shenzhen Component rose over 15%, outperforming global markets. The renminbi US dollar central parity rate was raised by 33 points to 7.103, the highest since November 6, 2024. The National Bureau of Statistics reported that the August manufacturing PMI was 49.4, up 0.1 from the previous month, but below market expectations, remaining in contraction territory for the fifth consecutive month. The non-manufacturing business activity index was 50.3, up 0.2 from the previous month, above the critical threshold, indicating continued expansion in the non-manufacturing sector. Alibaba reported revenue of 247.6 billion yuan for the first quarter of its 2026 fiscal year ending June, up 2% year-on-year, excluding disposed businesses like Sanat Retail and In Time. Adjusted revenue grew 10% year-on-year. Net profit surged 78% to 43.116 billion yuan, while non-GAAP adjusted net profit fell 18% to 33.5 billion yuan. Diluted EPS was 2.25 yuan, while non-GAAP adjusted earnings per share fell 10% to 1.84 yuan. All major segments saw revenue growth. E-commerce revenue rose 9% to 118.577 billion yuan. The International Digital Commerce Group, AIDC, revenue increased 19% to 34.741 billion yuan, driven by strong cross-border performance. And the Cloud Intelligence Group revenue grew 26% to 33.388 billion yuan, primarily due to public cloud revenue growth, including increased adoption of AI-related products. The company noted that AI-related product revenue achieved triple-digit year-on-year growth for 8 consecutive quarters, driven by AI demand and enhanced AI experiences for consumers and enterprises. Alibaba Cloud has returned to a rapid growth trajectory. Alibaba's US ADR surged 13% last Friday and today is expected to open higher, testing the double top resistance at 125 to 126 and potentially reaching $130. Major Chinese banks reported interim results last Friday, except for Agricultural Bank of China, which saw a 2.7% profit increase and a 2.7% rise in interim dividend to 0.1195 yuan. ICBC, CCB, and BOC reported lower profits and reduced interim dividends. In terms of payout ratios, Agricultural Bank fell at led at 32.3%, followed by ICBC and BOC at around 30%, while CCB Bank of Communications and PSBC had payout ratios below 30%, with CCB and PSBC at 28.6% and Bank of Communications at 26.5%. For net interest margins, PSBC led at 1.7%, followed by CCB at 1.4%, Agricultural Bank 1.32%, ICBC 1.3%, BOC 1.26%, and Bank of Communications 1.21%. Non-performing loan ratios for the four major banks declined from last year, with Agricultural Bank seeing the largest drop of 0.02 percentage points. Its non-performing loan ratio for corporate real estate was 5.35%, down 0.05 percentage points from last year, while ICBC and BOC saw increases of 0.38 and 0.44 percentage points respectively. CCB's ratio fell 0.05 percentage points to 4.74%, the lowest among the four major banks. Our stock pick today is Gauche Meditech. Gauche Meditech primarily engages in the research, development, production, and distribution of a wide range of ophthalmic medical equipment and consumables, while also providing related technical services to end users. The group has established a global 4+2 R&D framework with multiple R&D and production platforms in four Chinese cities: Shenzhen, Suzhou, Wuxi, and Wenzhou, and two additional platforms overseas in the Netherlands and Germany. Additionally, the group boasts a sales network covering 51 countries and regions globally, supported by 135 engineers in Greater China, enabling 24/7 technical support services for equipment. As of June 30, 2025, the group's product portfolio comprised 165 products, including proprietary products developed and manufactured in-house, as well as distributed products from brand partners. These products include diagnostic devices, therapeutic and surgical instruments, high-value consumables, and general consumables. The portfolio covers seven major ophthalmic subspecialties: retinal diseases, cataracts, refractive errors, glaucoma, ocular surface diseases, optometry, and pediatric ophthalmology, allowing the group to offer comprehensive product and service solutions to its clients. In April 2025, the group's self-developed corneal confocal microscopes T3600 and T3400 received product registration certificates. In June 2025, its self-developed fundus camera was approved for market launch. Furthermore, the group's self-developed intraocular lens implantation system and swab source biometry device obtained registration certificates in May and August 2025, respectively, further enriching its proprietary product line. For the 6 months ended June 30, 2025, the group recorded revenue of 653 million yuan, a 1.7% increase compared to the same period in 2024. Revenue from proprietary products contributed 203 million yuan, accounting for 38.3% of total product sales revenue, up from 33.6% in the first half of 2024. Net profit for the period rose 33.5% to 35.9 million yuan. The gross margin improved from 46.5% in the first half of 2024 to 48.3%, driven by a shift in the sales mix toward high margin ophthalmic medical consumables and sustained growth in technical service revenue. Looking ahead, the group will continue to implement its own brand plus premium import screwdriver strategy and pursue internationalization, aiming to enhance and diversify its product offerings while striving to become a global leader in the ophthalmic medical device industry. The recommended buy-in price is 7.6 Hong Kong dollars, with initial target prices of 8.2 and $8.6 and a stop loss at $7.2. I do not hold the aforementioned stock.